seen, but few people are responding by refusing to accept incremental risk. Markets have tended recently to move up on positive developments and to recover easily from negatives. I see few assets that people are eager to get rid of, and few forced sellers. Instead, most assets are strongly bid for. As a result, I'm not aware of any broad markets that I would describe as underpriced or uncrowded. It is what it is. We've been living in optimistic times. The cycle has been swinging strongly upward. Prices are elevated and risk premiums are slender. Trust has replaced skepticism, and eagerness has replaced reticence. Do you agree or disagree? That's the key question. Answer it first, and the implications for investing become clear. In the first quarter of this year, significant delinquencies occurred in subprime mortgages. Those directly involved lost a lot of money, and onlookers worried about contagion to other parts of the economy and other markets. In the second quarter, the impact reached CDOs or collateralized debt obligations, structured, tranched investing entities that had invested in subprime mortgage portfolios, and hedge funds that had bought CDO debt, including two Bear Stearns funds. Those who had to liquidate assets were forced, as usual in tough times, to sell what they could sell, not what they wanted to sell, and not just the offending subprime-linked assets. We began to read about ratings downgrades, margin calls and fire sales, the usual fuel for capital market meltdowns. And in the last few weeks we've begun to see investor reticence on the rise, with new low-grade debt issues repriced, postponed or pulled, leaving bridge loans unrefinanced. The last 4.5 years have been carefree, halcyon times for investors. That doesn't mean it'll stay that way. I'll give Warren Buffett the last word. As I often do, it's only when the tide goes out that you find out who's been swimming naked. Pollyannas take note, the tide cannot come in forever. It's all good. July 16, 2007. I want to point out emphatically that none of the comments in the July 2007 memo, and none of my other warnings, has anything to do with predicting the future. Everything you needed to know in the years leading up to the crash could be discerned through awareness of what was going on in the present. The reality of risk is much less simple and straightforward than the perception. People vastly overestimate their ability to recognize risk and underestimate what it takes to avoid it, thus, they accept risk unknowingly and in so doing contribute to its creation. That's why it's essential to apply uncommon, second-level thinking to the subject. Risk arises as investor behavior alters the market. Investors bid up assets, accelerating into the present appreciation that otherwise would have occurred in the future, and thus lowering prospective returns. And as their psychology strengthens and they become bolder and less worried, investors cease to demand adequate risk premiums. The ultimate irony lies in the fact that the reward for taking incremental risk shrinks as more people move to take it. Thus, the market is not a static arena in which investors operate. It is responsive, shaped by investors' own behavior. Their increasing confidence creates more that they should worry about, just as their rising fear and risk aversion combine to widen risk premiums at the same time as they reduce risk. I call this the perversity of risk. I wouldn't buy that at any price. Everyone knows it's too risky. That's something I've heard a lot in my life, and it has given rise to the best investment opportunities I've participated in. The truth is, the herd is wrong about risk at least as often as it is about return. A broad consensus that something's too hot to handle is almost always wrong. Usually it's the opposite that's true. I'm firmly convinced that investment risk resides most where it is least perceived, and vice versa. When everyone believes something is risky, their unwillingness to buy usually reduces its price to the point where it's not risky at all. Broadly negative opinion can make it the least risky thing, since all optimism has been driven out of its price. And, of course, as demonstrated by the experience of Nifty 50 investors, when everyone believes something embodies no risk, they usually bid it up to the point where it's enormously risky. No risk is feared, and thus no reward for risk-bearing, no risk premium, is demanded or provided. That can make the thing that's most esteemed the riskiest. This paradox exists because most investors think quality, as opposed to price, is the determinant of whether something's risky. But high-quality assets can be risky, and low-quality assets can be safe. It's just a matter of the price paid for them. Elevated popular opinion, then, isn't just the source of low return potential, but also of high risk. Everyone knows, April 26, 2007. Chapter 7. The most important thing is controlling risk. When you boil it all down, it's the investor's job to intelligently bear risk for profit. Doing it well is what separates the best from the rest. Outstanding investors, in my opinion, are distinguished at least as much for their ability to control risk as they are for generating return. High absolute return is much more recognizable and titillating than superior risk-adjusted performance. That's why it's high-returning investors who get their pictures in the papers. Since it's hard to gauge risk and risk-adjusted performance, even after the fact, and since the importance of managing risk is widely underappreciated, investors rarely gain recognition for having done a great job in this regard. That's especially true in good times. But in my opinion, great investors are those who take risks that are less than commensurate with the returns they earn. They may produce moderate returns with low risk, or high returns with moderate risk. But achieving high returns with high risk means very little, unless you can do it for many years, in which case that perceived high risk either wasn't really high or was exceptionally well managed. Consider the investors who are recognized for doing a great job, people such as Warren Buffett, Peter Lynch, Bill Miller, and Julian Robertson. In general, their records are remarkable because of their decades of consistency and absence of disasters, not just their high returns. Each may have had a bad year or two, but in general they dealt as well with risk as with return. Whatever few awards are presented for risk control, they're never given out in good times. The reason is that risk is covert, invisible. Risk, the possibility of loss, is not observable. What is observable is loss, and loss generally happens only when risk collides with negative events. This is a very important point, so let me give you a couple of analogies to make sure it's clear. Germs cause illness, but germs themselves are not illness. We might say illness is what results when germs take hold. Homes in California may or may not have construction flaws that would make them collapse during earthquakes. We find out only when earthquakes occur. Likewise, loss is what happens when risk meets adversity. Risk is the potential for loss if things go wrong. As long as things go well, loss does not arise. Risk gives rise to loss only when negative events occur in the environment. We must remember that when the environment is salutary, that is only one of the environments that could have materialized that day, or that year. This is Nassim Nicholas Taleb's idea of alternative histories, described in more detail in Chapter 16. The fact that the environment wasn't negative does not mean that it couldn't have been. Thus, the fact that the environment wasn't negative doesn't mean risk control wasn't desirable, even though, as things turned out, it wasn't needed at that time. The important thing here is the realization that risk may have been present even though loss didn't occur. Therefore, the absence of loss does not necessarily mean the portfolio was safely constructed. So, risk control can be present in good times, but it isn't observable because it's not tested. Ergo, there are no awards. Only a skilled and sophisticated observer can look at a portfolio in good times and divine whether it is a low-risk portfolio or a high-risk portfolio. In order for a portfolio to make it through tough times, the risk generally has to be well controlled. If the portfolio thrives in good times, however, we can't tell whether risk control was A. present but not required or B. lacking. Bottom line, risk control is invisible in good times but still essential, since good times can so easily turn into bad times. What's the definition of a job well done? Most observers think the advantage of inefficient markets lies in the fact that a manager can take the same risk as a benchmark, for example, and earn a superior rate of return. It presents this idea and depicts the manager's alpha, or value added through skill. This manager has done a good job, but I think this is only half the story, and for me the uninteresting half. An inefficient market can also allow a skilled investor to achieve the same return as the benchmark while taking less risk, and I think this is a great accomplishment. Here the manager's value added comes not through higher return at a given risk, but through reduced risk at a given return. This, too, is a good job, maybe even a better one. Some of this is semantic and depends on how you look at the graphs. But because I think fundamental risk reduction can provide the foundation for an extremely successful investing experience, this concept should receive more attention than it does. How do you enjoy the full gain in up markets while simultaneously risk-return portfolio benchmark value added being positioned to achieve superior performance in down markets? By capturing the up market gain while bearing below market risk, no mean feat, returns, absolute returns and risk, June 13, 2006. Now we come back to the germs that haven't taken hold, or perhaps the earthquakes that haven't happened. A good builder is able to avoid construction flaws, while a poor builder incorporates construction flaws. When there are no earthquakes, you can't tell the difference. Likewise, an excellent investor may be one who, rather than reporting higher returns than others, achieves the same return but does so with less risk, or even achieves a slightly lower return with far less risk. Of course, when markets are stable or rising, we don't get to find out how much risk a portfolio entailed. That's what's behind Warren Buffett's observation that other than when the tide goes out, we can't tell which swimmers are clothed and which are naked. It's an outstanding accomplishment to achieve the same return as the risk bearers and do so with less risk. But most of the time it's a subtle, hidden risk-return portfolio benchmark value added accomplishment that can be appreciated only through sophisticated judgments. Since usually there are more good years in the markets than bad years, and since it takes bad years for the value of risk control to become evident in reduced losses, the cost of risk control, in the form of return foregone, can seem excessive. In good years in the market, risk-conscious investors must content themselves with the knowledge that they benefited from its presence in the portfolio, even though it wasn't needed. They're like the prudent homeowners who carry insurance and feel good about having protection in place, even when there's no fire. Controlling the risk in your portfolio is a very important and worthwhile pursuit. The fruits, however, come only in the form of losses that don't happen. Such what-if calculations are difficult in placid times. Bearing risk unknowingly can be a huge mistake, but it's what those who buy the securities that are all the rage and most highly esteemed at a particular point in time, to which nothing bad can possibly happen, repeatedly do. On the other hand, the intelligent acceptance of recognized risk for profit underlies some of the wisest, most profitable investments, even though, or perhaps due to the fact that, most investors dismiss them as dangerous speculations. When you boil it all down, it's the investor's job to intelligently bear risk for profit. Doing it well is what separates the best from the rest. What does it mean to intelligently bear risk for profit? Let's take the example of life insurance. How can life insurance companies, some of the most conservative companies in America, insure people's lives when they know they're all going to die? It's risk they're aware of. They know everyone's going to die. Thus they factor this reality into their approach. It's risk they can analyze. That's why they have doctors assess applicants' health. It's risk they can diversify. By ensuring a mix of policyholders by age, gender, occupation and location, they make sure they're not exposed to freak occurrences and widespread losses. And it's risk they can be sure they're well paid to bear. They set premiums so they'll make a profit if the policyholders die according to the actuarial tables on average. And if the insurance market is inefficient, for example, if the company can sell a policy to someone likely to die at age 80 at a premium that assumes he'll die at 70, they'll be better protected against risk and positioned for exceptional profits if things go as expected. We do exactly the same things in high-yield bonds, and in the rest of Oaktree's strategies. We try to be aware of the risks, which is essential given how much our work involves assets that some simplistically call risky. We employ highly skilled professionals capable of analyzing investments and assessing risk. We diversify our portfolios appropriately. And we invest only when we're convinced the likely return far more than compensates for the risk. I've said for years that risky assets can make for good investments if they're cheap enough. The essential element is knowing when that's the case. That's it, the intelligent bearing of risk for profit, the best test for which is a record of repeated success over a long period of time. Risk, January 19, 2006. While risk control is essential, risk bearing is neither wise nor unwise per se. It's inevitably part of most investment strategies and investment niches. It can be done well or poorly, and at the right time or the wrong time. If you have enough skill to be able to move into the more aggressive niches with risk under control, it's the best thing possible. But the potential pitfalls are many, and they must be avoided. Careful risk controllers know they don't know the future. They know it can include some negative outcomes, but not how bad they might be, or exactly what their probabilities are. Thus, the principal pitfalls come in the inability to know how bad is bad, and in resulting poor decisions. Extreme volatility and loss surface only infrequently. And as time passes without that happening, it appears more and more likely that it'll never happen, that assumptions regarding risk were controlling risk 63 too conservative. Thus, it becomes tempting to relax rules and increase leverage. And often this is done just before the risk finally rears its head. As Nassim Nicholas Taleb wrote in Fooled by Randomness, reality is far more vicious than Russian roulette. First, it delivers the fatal bullet rather infrequently, like a revolver that would have hundreds, even thousands of chambers instead of 6. After a few dozen tries, one forgets about the existence of a bullet, under a numbing false sense of security. Second, unlike a well-defined precise game like Russian roulette, where the risks are visible to anyone capable of multiplying and dividing by 6, one does not observe the barrel of reality. One is thus capable of unwittingly playing Russian roulette, and calling it by some alternative, low-risk name. The financial institutions played a high-risk game in 2004 to 2007 thinking it was a low-risk game, all because their assumptions on losses and volatility were too low. We'd be watching an entirely different picture if only they'd said, this stuff is potentially risky. Since home prices have gone up so much and mortgages have been available so easily, there just might be widespread declines in home prices this time. So we're only going to lever up half as much as past performance might suggest. It's easy to say they should have made more conservative assumptions. But how conservative? You can't run a business on the basis of worst-case assumptions. You wouldn't be able to do anything. And anyway, a worst-case assumption is really a misnomer. There's no such thing, short of a total loss. Now, we know the quants shouldn't have assumed there couldn't be a nationwide decline in home prices. But once you grant that such a decline can happen, for the first time, what extent should you prepare for? 2%. 10. 50. The 2008 headlines are full of entities that have seen massive losses, and perhaps meltdowns, because they bought assets using leverage. These investors put on leverage that might have been appropriate with moderate volatility assets and ran into the greatest volatility ever seen. It's easy to say they made a mistake, but is it reasonable to expect them to have girded for unique events. If every portfolio was required to be able to withstand declines on the scale we've witnessed this year, 2008, it's possible no leverage would ever be used. Is that a reasonable reaction? In fact, it's possible that no one would ever invest in these asset classes, even on an unlevered basis. In all aspects of our lives, we base our decisions on what we think probably will happen. And, in turn, we base that to a great extent on what usually happened in the past. We expect results to be close to the norm, most of the time, but we know it's not unusual to see outcomes that are better, B, or worse, C. Although we should bear in mind that, once in a while, a result will be outside the usual range, D, we tend to forget about the potential for outliers. And importantly, as illustrated by recent events, we rarely consider outcomes that have happened only once a century or never, E. Even if we realize that unusual, unlikely things can happen, in order to act we make reasoned decisions and knowingly accept that risk when well paid to do so. Once in a while, a black swan will materialize. But if in the future we always said, we can't do A, C, B, E, D such and such, because the outcome could be worse than we've ever seen before, we'd be frozen in inaction. So in most things, you can't prepare for the worst case. It should suffice to be prepared for once-in-a-generation events. But a generation isn't forever, and there will be times when that standard is exceeded. What do you do about that? I've mused in the past about how much one should devote to preparing for the unlikely disaster. Among other things, the events of 2007 to 2008 prove there's no easy answer. Volatility plus leverage equals dynamite, December 17, 2008. Especially in view of the vagaries presented previously in this chapter, I want to make clear the important distinction between risk control and risk avoidance. Risk control is the best route to loss. Avoidance. Risk avoidance, on the other hand, is likely to lead to return avoidance as well. Once in a while I hear someone talk about Oaktree's desire to avoid investment risk and I take great issue. Clearly, Oaktree doesn't run from risk. We welcome it at the right time, in the right instances, and at the right price. We could easily avoid all risk, and so could you. But we'd be assured of avoiding returns above the risk-free rate as well. Will Rogers said, "You've got to go out on a limb sometimes because that's where the fruit is." None of us is in this business to make 4%. So even though the first tenet in Oaktree's investment philosophy stresses the importance of risk control, this has nothing to do with risk avoidance. It's by bearing risk when we're well paid to do so, and especially by taking risks toward which others are averse in the extreme, that we strive to add value for our clients. When formulated that way, it's obvious how big a part risk plays in our process. Rick Funston of Deloitte and Touche said in the article that prompted this memo, "When corporate risk becomes personal," corporate board member, 2005 special supplement, "You need comfort that the risks and exposures are understood, appropriately managed, and made more transparent for everyone. This is not risk aversion, it is risk intelligence." That's what Oaktree strives for every day. Risk, January 19, 2006. The road to long-term investment success runs through risk control more than through aggressiveness. Over a full career, most investors' results will be determined more by how many losers they have, and how bad they are, than by the greatness of their winners. Skillful risk control is the mark of the superior investor. Chapter 8. The most important thing is being attentive to cycles. I think it's essential to remember that just about everything is cyclical. There's little I'm certain of, but these things are true: cycles always prevail eventually. Nothing goes in one direction forever. Trees don't grow to the sky. Few things go to zero. And there's little that's as dangerous for investor health as insistence on extrapolating today's events into the future. The more time I spend in the world of investing, the more I appreciate the underlying cyclicality of things. In November 2001, I devoted an entire memo to the subject. I titled it, "You Can't Predict. You Can Prepare," borrowing the advertising tagline of MassMutual Life Insurance Company because I agree wholeheartedly with their theme. We never know what lies ahead, but we can prepare for the possibilities and reduce their sting. In investing, as in life, there are very few sure things. Values can evaporate, estimates can be wrong, circumstances can change, and sure things can fail. However, there are two concepts we can hold to with confidence. Rule number 1, most things will prove to be cyclical. Rule number 2, some of the greatest opportunities for gain and loss come when other people forget rule number 1. Very few things move in a straight line. There's progress and then there's deterioration. Things go well for a while and then poorly. Progress may be swift and then slow down. Deterioration may creep up gradually and then turn climactic. But the underlying principle is that things will wax and wane, grow and decline. The same is true for economies, markets and companies. They rise and fall. The basic reason for the cyclicality in our world is the involvement of humans. Mechanical things can go in a straight line. Time moves ahead continuously. So can a machine when it's adequately powered. But processes in fields like history and economics involve people, and when people are involved, the results are variable and cyclical. The main reason for this, I think, is that people are emotional and inconsistent, not steady and clinical. Objective factors do play a large part in cycles, of course, factors such as quantitative relationships, world events, environmental changes, technological developments and corporate decisions. But it's the application of psychology to these things that causes investors to overreact or underreact, and thus determines the amplitude of the cyclical fluctuations. When people feel good about the way things are going and optimistic about the future, their behavior is strongly impacted. They spend more and save less. They borrow to increase their enjoyment or their profit potential, even though doing so makes their financial position more precarious. Of course, concepts like precariousness are forgotten in optimistic times. And they become willing to pay more for current value or a piece of the future. All of these things are capable of reversing in a second. One of my favorite cartoons features a TV commentator saying, "Everything that was good for the market yesterday is no good for it today." The extremes of cycles result largely from people's emotions and foibles, non-objectivity and inconsistency. Cycles are self-correcting, and their reversal is not necessarily dependent on exogenous events. They reverse, rather than going on forever, because trends create the reasons for their own reversal. Thus, I like to say success carries within itself the seeds of failure, and failure the seeds of success. You can't predict. You can prepare. November 20th, 2001. The credit cycle deserves a very special mention for its inevitability, extreme volatility, and ability to create opportunities for investors attuned to it. Of all the cycles, it's my favorite. The longer I'm involved in investing, the more impressed I am by the power of the credit cycle. It takes only a small fluctuation in the economy to produce a large fluctuation in the availability of credit, with great impact on asset prices and back on the economy itself. The process is simple: the economy moves into a period of prosperity. Providers of capital thrive, increasing their capital base. Because bad news is scarce, the risks entailed in lending and investing seem to have shrunk. Risk averseness disappears. Financial institutions move to expand their businesses, that is, to provide more capital. They compete for market share by lowering demanded returns, example, cutting interest rates, lowering credit standards, providing more capital for a given transaction and easing covenants. At the extreme, providers of capital finance borrowers and projects that aren't worthy of being financed. As The Economist said earlier this year, the worst loans are made at the best of times. This leads to capital destruction, that is, to investment of capital in projects where the cost of capital exceeds the return on capital, and eventually to cases where there is no return of capital. When this point is reached, the up leg described above, the rising part of the cycle, is reversed. Losses cause lenders to become discouraged and shy away. Risk averseness rises, and along with it, interest rates, credit restrictions and covenant requirements. Less capital is made available, and at the trough of the cycle, only to the most qualified of borrowers, if anyone. Companies become starved for capital. Borrowers are unable to roll over their debts, leading to defaults and bankruptcies. This process contributes to and reinforces the economic contraction. Of course, at the extreme the process is ready to be reversed again. Because the competition to make loans or investments is low, high returns can be demanded along with high creditworthiness. Contrarians who commit capital at this point have a shot at high returns, and those tempting potential returns begin to draw in capital. In this way, a recovery begins to be fueled. I stated earlier that cycles are self-correcting. The credit cycle corrects itself through the processes described above, and it represents one of the factors driving the fluctuations of the economic cycle. Prosperity brings expanded lending, which leads to unwise lending, which produces large losses, which makes lenders stop lending, which ends prosperity, and on and on. Look around the next time there's a crisis, you'll probably find a lender. Over-permissive providers of capital frequently aid and abet financial bubbles. There have been numerous recent examples where loose credit contributed to booms that were followed by famous collapses: real estate in 1989 to 1992, emerging markets in 1994 to 1998, long-term capital management in 1998, the movie exhibition industry in 1999 to 2000, venture capital funds and telecommunications companies in 2000 to 2001. In each case, lenders and investors provided too much cheap money and the result was overexpansion and dramatic losses. In Field of Dreams, Kevin Costner was told, "If you build it, they will come." In the financial world, if you offer cheap money, they will borrow, buy and build, often without discipline, and with very negative consequences. You can't predict. You can prepare. November 20th, 2001. Please note that this memo, written almost 10 years ago, perfectly describes the process through which the 2007 to 2008 financial crisis arose. It wasn't predictive ability that enabled me to write it, just familiarity with a never-ending underlying cycle. Cycles will never stop occurring. If there were such a thing as a completely efficient market, and if people really made decisions in a calculating and unemotional manner, perhaps cycles, or at least their extremes, would be banished. But that'll never be the case. Economies will wax and wane as consumers spend more or less, responding emotionally to economic factors or exogenous events, geopolitical or naturally occurring. Companies will anticipate a rosy future during the upcycle and thus overexpand facilities and inventories. These will become burdensome when the economy turns down. Providers of capital will be too generous when the economy's doing well, abetting overexpansion with cheap money, and then they'll pull the reins too tight when things cease to look as good. Investors will overvalue companies when they're doing well and undervalue them when things get difficult. And yet, every decade or so, people decide cyclicality is over. They think either the good times will roll on without end or the negative trends can't be arrested. At such times they talk about virtuous cycles, or vicious cycles, self-feeding developments that will go on forever in one direction or the other. Case in point, on November 15, 1996, the Wall Street Journal reported on a growing consensus, from boardrooms to living rooms and from government offices to trading floors, a new consensus is emerging: the big, bad business cycle has been tamed. Does anyone remember a steady, non-cyclical economic environment in the years since then? What would explain the emerging crisis of 1998, the recession of 2002, and the financial crisis, and worst recession since World War II, of 2008? This belief that cyclicality has been ended exemplifies a way of thinking based on the dangerous premise that, this time it's different. These 4 words should strike fear, and perhaps suggest an opportunity for profit, for anyone who understands the past and knows it repeats. Thus, it's essential that you be able to recognize this form of error when it arises. One of my favorite books is a little volume titled Oh Yeah, a 1932 compilation of pre-Depression wisdom from businessmen and political leaders. It seems that even then, pundits were predicting a cycle. Free economy, there will be no interruption of our present prosperity. Myron E. Forbes. President, Pierce Arrow Motor Car Company, January 1, 1928. I cannot help but raise a dissenting voice to the statements that prosperity in this country must necessarily diminish and recede in the future. E. H. Simmons, President, New York Stock Exchange, January 12, 1928. We are only at the beginning of a period that will go down in history as the Golden Age. Irving T. Bush, President, Bush Terminal Company, November 15, 1928. The fundamental business of the country is on a sound and prosperous basis. President Herbert Hoover, October 25, 1929. Every once in a while, an up or down leg goes on for a long time and or to a great extreme, and people start to say, this time it's different. They cite the changes in geopolitics, institutions, technology or behavior that have rendered the old rules obsolete. They make investment decisions that extrapolate the recent trend. And then it turns out that the old rules do still apply, and the cycle resumes. In the end, trees don't grow to the sky, and few things go to zero. Rather, most phenomena turn out to be cyclical. You can't predict. You can prepare. November 20th, 2001. We conclude that most of the time, the future will look a lot like the past, with both up cycles and down cycles. There is a right time to argue that things will be better, and that's when the market is on its backside and everyone else is selling things at giveaway prices. It's dangerous when the market's at record levels to reach for a positive rationalization that has never held true in the past. But it's been done before, and it'll be done again. Will it be different this time? November 25, 1996. Ignoring cycles and extrapolating trends is one of the most dangerous things an investor can do. People often act as if companies that are doing well will do well forever, and investments that are outperforming will outperform forever, and vice versa. Instead, it's the opposite that's more likely to be true. The first-time rookie investors see this phenomenon occur, it's understandable that they might accept that something that's never happened before, the cessation of cycles, could happen. But the second time or the third time, those investors, now experienced, should realize it's never going to happen, and turn that realization to their advantage. The next time you're approached with a deal predicated on cycles having ceased to occur, remember that invariably that's a losing bet. Chapter 9. The most important thing is awareness of the pendulum. When things are going well and prices are high, investors rush to buy, forgetting all prudence. Then, when there's chaos all around and assets are on the bargain counter, they lose all willingness to bear risk and rush to sell. And it will ever be so. The second investor memo I ever wrote, back in 1991, was devoted almost entirely to a subject that I have come to think about more and more over the years, the pendulum-like oscillation of investor attitudes and behavior. The mood swings of the securities markets resemble the movement of a pendulum. Although the midpoint of its arc best describes the location of the pendulum, on average, it actually spends very little of its time there. Instead, it is almost always swinging toward or away from the extremes of its arc. But whenever the pendulum is near either extreme, it is inevitable that it will move back toward the midpoint sooner or later. In fact, it is the movement toward an extreme itself that supplies the energy for the swing back. Investment markets follow a pendulum-like swing, between euphoria and depression, between celebrating positive developments and obsessing over negatives, and thus, between overpriced and underpriced. This oscillation is one of the most dependable features of the investment world, and investor psychology seems to spend much more time at the extremes than it does at a happy medium. First quarter performance. April 11, 1991. 13 years later I revisited the subject of the pendulum at length in another memo. In it I observed that in addition to the elements mentioned earlier, the pendulum also swings with regard to greed versus fear, willingness to view things through an optimistic or a pessimistic lens, faith in developments that are on the come, credulousness versus skepticism, and risk tolerance versus risk aversion. The swing in the last of these, attitudes toward risk, is a common thread that runs through many of the market's fluctuations. Risk aversion is the essential ingredient in a rational market, as I said before, and the position of the pendulum with regard to it is particularly important. Improper amounts of risk aversion are key contributors to the market excesses of bubble and crash. It's an oversimplification, but not a grievous one, to say the inevitable hallmark of bubbles is a dearth of risk aversion. In crashes, on the other hand, investors fear too much. Excessive risk aversion keeps them from buying even when no optimism, only pessimism, is embodied in prices. And valuations are absurdly low. In my opinion, the greed/fear cycle is caused by changing attitudes toward risk. When greed is prevalent, it means investors feel a high level of comfort with risk and the idea of bearing it in the interest of profit. Conversely, widespread fear indicates a high level of aversion to risk. The academics consider investors' attitude toward risk a constant, but certainly it fluctuates greatly. Finance theory is heavily dependent on the assumption that investors are risk-averse. That is, they disprefer risk and must be induced, bribed, to bear it, with higher expected returns. Reaping dependably high returns from risky investments is an oxymoron. But there are times when this caveat is ignored, when people get too comfortable with risk and thus when prices of securities incorporate a premium for bearing risk that is inadequate to compensate for the risk that's present. When investors in general are too risk-tolerant, security prices can embody more risk than they do return. When investors are too risk-averse, prices can offer more return than risk. The happy medium, July 21, 2004. The pendulum swing regarding attitudes toward risk is one of the most powerful of all. In fact, I've recently boiled down the main risks in investing to two: the risk of losing money and the risk of missing opportunity. It's possible to largely eliminate either one, but not both. In an ideal world, investors would balance these two concerns. But from time to time, at the extremes of the pendulum's swing, one or the other predominates. For example, in 2005, 2006, and early 2007, with things going so swimmingly and the capital markets wide open, few people imagined that losses could lie ahead. Many believed risk had been banished. Their only worry was that they might miss an opportunity. If Wall Street came out with a new financial miracle and other investors bought and they didn't, and if the miracle worked, they might look unprogressive and lose ground. Since they weren't concerned about losing money, they didn't insist on low purchase prices, adequate risk premiums, or investor protection. In short, they behaved too aggressively. Then in late 2007 and 2008, with the credit crisis in full flower, people began to fear a complete meltdown of the world financial system. No one worried about missing opportunity. The pendulum had swung to the point where people worried only about losing money. Thus, they ran from anything with a scintilla of risk, regardless of the potential return, and to the safety of government securities with yields near zero. At this point, then, investors feared too much, sold too eagerly, and positioned their portfolios too defensively. Thus, the last several years have provided an unusually clear opportunity to witness the swing of the pendulum and how consistently most people do the wrong thing at the wrong time. When things are going well and prices are high, investors rush to buy, forgetting all prudence. Then, when there's chaos all around and assets are on the bargain counter, they lose all willingness to bear risk and rush to sell. And it will ever be so. Very early in my career, a veteran investor told me about the 3 stages of a bull market. Now I'll share them with you. The first, when a few forward-looking people begin to believe things will get better. The second, when most investors realize improvement is actually taking place. The third, when everyone concludes things will get better forever. Why would anyone waste time trying for a better description? This one says it all. It's essential that we grasp its significance. The market has a mind of its own, and its changes in valuation parameters, caused primarily by changes in investor psychology, not changes in fundamentals, that account for most short-term changes in security prices. This psychology, too, moves like a pendulum. Stocks are cheapest when everything looks grim. The depressing outlook keeps them there, and only a few astute and daring bargain hunters are willing to take new positions. Maybe their buying attracts some attention, or maybe the outlook turns a little less depressing, but for one reason or another, the market starts moving up. After a while, the outlook seems a little less poor. People begin to appreciate that improvement is taking place. And it requires less imagination to be a buyer. Of course, with the economy and market off the critical list, they pay prices that are more reflective of stocks' fair values. And eventually, giddiness sets in. Cheered by the improvement in economic and corporate results, people become willing to extrapolate it. The masses become excited and envious about the profits made by investors who were early, and they want in. And they ignore the cyclical nature of things and conclude that the gains will go on forever. That's why I love the old adage, what the wise man does in the beginning, the fool does in the end. Most important, in the late stages of the great bull markets, people become willing to pay prices for stocks that assume the good times will go on ad infinitum. You can't predict. You can prepare. November 20th, 2001. 5 years after I first learned about the stages of a bull market, after the weaknesses of subprime mortgages, and their holders, had been exposed, and as people were worrying about contagion to a global crisis, I came up with the flip side, the 3 stages of a bear market. The first, when just a few thoughtful investors recognize that, despite the prevailing bullishness, things won't always be rosy. The second, when most investors recognize things are deteriorating. The third, when everyone's convinced things can only get worse. Certainly we're well into the second of these 3 stages. There's been lots of bad news and write-offs. More and more people recognize the dangers inherent in things like innovation, leverage, derivatives, counterparty risk, and mark-to-market accounting. And increasingly the problems seem insolvable. One of these days, though, we'll reach the 3rd stage, and the herd will give up on there being a solution. And unless the financial world really does end, we're likely to encounter the investment opportunities of a lifetime. Major bottoms occur when everyone forgets that the tide also comes in. Those are the times we live for. The tide goes out, March 18, 2008. Just 6 months after those words were written, the progression had gone all the way to the 3rd stage. A full meltdown of the world financial system was considered possible. In fact, the first steps, the bankruptcy of Lehman Brothers and the absorption or rescue of Bear Stearns, Merrill Lynch, AIG, Fannie Mae, Freddie Mac, Wachovia, and WAMU, had taken place. Since this was the biggest crisis ever, investors bought into the 3rd stage, during which everyone's convinced things can only get worse, more than ever before. Thus, in many asset classes, the things determined by the pendulum swing, the price declines in 2008, the resultant investment opportunities at the nadir, and the gains in 2009, were the greatest I've ever seen. The significance of all this is the opportunity it offers to those who recognize what is happening and see the implications. At one extreme of the pendulum, the darkest of times, it takes analytical ability, objectivity, resolve, even imagination, to think things will ever get better. The few people who possess those qualities can make unusual profits with low risk. But at the other extreme, when everyone assumes and prices in the impossible, improvement forever, the stage is set for painful losses. It all goes together. None of these is an isolated event or a chance occurrence. Rather, they're all elements in a recurring pattern that can be understood and profited from. The oscillation of the investor pendulum is very similar in nature to the up and down fluctuation of economic and market cycles described in Chapter 8. For some reason I find myself making a distinction between the two and speaking of them in different terms, but they're both highly important, and the key lessons are the same. With the benefit of almost 20 years' experience since writing that first memo about the pendulum in 1991, I'll rephrase its key observations. In theory, with regard to polarities such as fear and greed, the pendulum should reside mostly at a midpoint between the extremes. But it doesn't for long. Primarily because of the workings of investor psychology, it's usually swinging toward or back from one extreme or the other. The pendulum cannot continue to swing toward an extreme or reside at an extreme forever, although when it's positioned at its greatest extreme, people increasingly describe that as having become a permanent condition. Like a pendulum, the swing of investor psychology toward an extreme causes energy to build up that eventually will contribute to the swing back in the other direction. Sometimes, the pent-up energy is itself the cause of the swing back, that is, the pendulum's swing toward an extreme corrects of its very weight. The swing back from the extreme is usually more rapid, and thus takes much less time, than the swing to the extreme. Or as my partner Sheldon Stone likes to say, the air goes out of the balloon much faster than it went in. The occurrence of this pendulum-like pattern in most market phenomena is extremely dependable. But just like the oscillation of cycles, we never know how far the pendulum will swing in its arc, what might cause the swing to stop and turn back, when this reversal will occur, or how far it will then swing in the opposite direction. For a bullish phase to hold sway, the environment has to be characterized by greed, optimism, exuberance, confidence, credulity, daring, risk tolerance and aggressiveness. But these traits will not govern a market forever. Eventually they will give way to fear, pessimism, prudence, uncertainty, skepticism, caution, risk aversion and reticence. Busts are the product of booms, and I'm convinced it's usually more correct to attribute a bust to the excesses of the preceding boom than to the specific event that sets off the correction. Now what? January 10, 2008. There are a few things of which we can be sure, and this is one: extreme market behavior will reverse. Those who believe that the pendulum will move in one direction forever, or reside at an extreme forever, eventually will lose huge sums. Those who understand the pendulum's behavior can benefit enormously. Chapter 10. The most important thing is combating negative influences. The desire for more, the fear of missing out, the tendency to compare against others, the influence of the crowd and the dream of the sure thing, these factors are near universal. Thus they have a profound collective impact on most investors and most markets. The result is mistakes, and those mistakes are frequent, widespread and recurring. Inefficiencies, mispricings, misperceptions, mistakes that other people make, provide potential opportunities for superior performance. Exploiting them is, in fact, the only road to consistent outperformance. To distinguish yourself from the others, you need to be on the right side of those mistakes. Why do mistakes occur? Because investing is an action undertaken by human beings, most of whom are at the mercy of their psyches and emotions. Many people possess the intellect needed to analyze data, but far fewer are able to look more deeply into things and withstand the powerful influence of psychology. To say this another way, many people will reach similar cognitive conclusions from their analysis, but what they do with those conclusions varies all over the lot because psychology influences them differently. The biggest investing errors come not from factors that are informational or analytical, but from those that are psychological. Investor psychology includes many separate elements, which we will look at in this chapter, but the key thing to remember is that they consistently lead to incorrect decisions. Much of this falls under the heading of human nature. The first emotion that serves to undermine investors' efforts is the desire for money, especially as it morphs into greed. Most people invest to make money. Some participate as an intellectual exercise or because it's a good field in which to vent their competitiveness, but even they keep score in terms of money. Money may not be everyone's goal for its own sake, but it is everyone's unit of account. People who don't care about money generally don't go into investing. There's nothing wrong with trying to make money. Indeed, the desire for gain is one of the most important elements in the workings of the market and the overall economy. The danger comes when it moves on further to greed, which Merriam-Webster's defines as an inordinate or all-consuming and usually reprehensible acquisitiveness, especially for wealth or gain. Greed is an extremely powerful force. It's strong enough to overcome common sense, risk aversion, prudence, caution, logic, memory of painful past lessons, resolve, trepidation, and all the other elements that might otherwise keep investors out of trouble. Instead, from time to time greed drives investors to throw in their lot with the crowd in pursuit of profit, and eventually they pay the price. The combination of greed and optimism repeatedly leads people to pursue strategies they hope will produce high returns without high risk, pay elevated prices for securities that are in vogue, and hold things after they have become highly priced in the hope there's still some appreciation left. Afterwards, hindsight shows everyone what went wrong, that expectations were unrealistic and risks were ignored. Hindsight first, please, or what were they thinking? October 17, 2005. The counterpart of greed is fear, the second psychological factor we must consider. In the investment world, the term doesn't mean logical, sensible risk aversion. Rather, fear, like greed, connotes excess. Fear, then, is more like panic. Fear is overdone concern that prevents investors from taking constructive action when they should. Many times over the course of my career, I've been amazed by how easy it is for people to engage in willing suspension of disbelief. Thus, the third factor I want to discuss is people's tendency to dismiss logic, history, and time-honored norms. This tendency makes people accept unlikely propositions that have the potential to make them rich, if only they held water. Charlie Munger gave me a great quotation on this subject, from Demosthenes: "Nothing is easier than self-deceit. For what each man wishes, that he also believes to be true." The belief that some fundamental limiter is no longer valid, and thus historic notions of fair value no longer matter, is invariably at the core of every bubble and consequent crash. In fiction, willing suspension of disbelief adds to our enjoyment. When we watch Peter Pan, we don't want to hear the person sitting next to us say, "I can see the wires," even though we know they're there. While we know boys can't fly, we don't care, we're just there for fun. But our purpose in investing is serious, not fun, and we must constantly be on the lookout for things that can't work in real life. In short, the process of investing requires a strong dose of disbelief. Inadequate skepticism contributes to investment losses. Time and time again, the postmortems of financial debacles include two classic phrases: "It was too good to be true," and "What were they thinking?" Hindsight first, please, or "What were they thinking?" October 17, 2005. What makes investors fall for these delusions? The answer often lies in the ease with which, often in service to greed, they dismiss or ignore the lessons of the past. Extreme brevity of the financial memory, to use John Kenneth Galbraith's wonderful phrase keeps market participants from recognizing the recurring nature of these patterns. And thus their inevitability, when the same or closely similar circumstances occur again, sometimes in only a few years, they are hailed by a new, often youthful, and always supremely self-confident generation as a brilliantly innovative discovery in the financial and larger economic world. There can be few fields of human endeavor in which history counts for so little as in the world of finance. Past experience, to the extent that it is part of memory at all, is dismissed as the primitive refuge of those who do not have the insight to appreciate the incredible wonders of the present. John Kenneth Galbraith, A Short History of Financial Euphoria, New York, Viking, 1990, the infallible investment that people come to believe can produce high returns without risk, the sure thing or free lunch, is well worth further discussion. When a market, an individual, or an investment technique produces impressive returns for a while, it generally attracts excessive, and unquestioning, devotion. I call this solution du jour, the silver bullet. Investors are always looking for it. Call it the holy grail or the free lunch, but everyone wants a ticket to riches without risk. Few people question whether it can exist or why it should be available to them. At the bottom line, hope springs eternal. But the silver bullet doesn't exist. No strategy can produce high rates of return without risk. And nobody has all the answers, we're all just human. Markets are highly dynamic, and, among other things, they function over time to take away the opportunity for unusual profits. Unskeptical belief that the silver bullet is at hand eventually leads to capital punishment. The Realist's Creed, May 31, 2002. What makes for belief in silver bullets? First, there's usually a germ of truth. It's spun into an intelligent-sounding theory, and adherents get on their soapboxes to convince others. Then it produces profits for a while. Whether because there's merit in it or just because buying on the part of new converts lifts the price of the subject asset. Eventually, the appearance that, A, there's a path to sure wealth and, B, it's working turns it into a mania. As Warren Buffett told Congress on June 2, 2010, rising prices are a narcotic that affects the reasoning power up and down the line. But after the fact, after it has popped, a mania is called a bubble. The fourth psychological contributor to investor error is the tendency to conform to the view of the herd rather than resist, even when the herd's view is clearly cockeyed. In How Markets Fail, John Cassidy describes classic psychology experiments conducted by Swarthmore's Solomon Asch in the 1950s. Asch asked groups of subjects to make judgments about visual exhibits, but all but one of the subjects in each group were shills working for him. The shills intentionally said the wrong thing, with dramatic impact on the one real subject. Cassidy explains, this setup placed the genuine subject in an awkward spot, as Asch put it, upon him we have brought to bear two opposed forces, the evidence of his senses and the unanimous opinion of a group of his peers. A high percentage of the real subjects ignored what they saw and sided with the other group members, even though they were obviously in the wrong. This indicates the influence of the crowd and thus suggests reservations about the validity of consensus decisions. Like the participants in Solomon Asch's visual experiments in the 1950s, Cassidy writes, many people who don't share the consensus view of the market start to feel left out. Eventually it reaches a stage where it appears the really crazy people are those not in the market. Time and time again, the combination of pressure to conform and the desire to get rich causes people to drop their independence and skepticism, overcome their innate risk aversion and believe things that don't make sense. It happens so regularly that there must be something dependable at work, not a random influence. The fifth psychological influence is envy. However negative the force of greed might be, always spurring people to strive for more and more, the impact is even stronger when they compare themselves to others. This is one of the most harmful aspects of what we call human nature. People who might be perfectly happy with their lot in isolation become Miserable when they see others do better. In the world of investing, most people find it terribly hard to sit by and watch while others make more money than they do. I know of a non-profit institution whose endowment earned 16% a year from June 1994 to June 1999, but since its peers averaged 23%, the people involved with the endowment were dejected. Without growth stocks, technology stocks, buyouts and venture capital, the endowment was entirely out of step for half a decade. But then the tech stocks collapsed, and from June 2000 to June 2003 the institution earned 3% a year while most endowments suffered losses. The stakeholders were thrilled. There's something wrong with this picture. How can people be unhappy making 16% a year and happy making 3%? The answer lies in a tendency to compare ourselves to others and the deleterious impact this can have on what should be a constructive, analytical process. The sixth key influence is ego. It can be enormously challenging to remain objective and calculating in the face of facts like these. Investment results are evaluated and compared in the short run. Incorrect, even imprudent, decisions to bear increased risk generally lead to the best returns in good times, and most times are good times. The best returns bring the greatest ego rewards. When things go right, it's fun to feel smart and have others agree. In contrast, thoughtful investors can toil in obscurity, achieving solid gains in the good years and losing less than others in the bad. They avoid sharing in the riskiest behavior because they're so aware of how much they don't know and because they have their egos in check. This, in my opinion, is the greatest formula for long-term wealth creation, but it doesn't provide much ego gratification in the short run. It's just not that glamorous to follow a path that emphasizes humility, prudence and risk control. Of course, investing shouldn't be about glamour, but often it is. Finally, I want to mention a phenomenon I call capitulation, a regular feature of investor behavior late in cycles. Investors hold to their convictions as long as they can, but when the economic and psychological pressures become irresistible, they surrender and jump on the bandwagon. In general, people who go into the investment business are intelligent, educated, informed and numerate. They master the nuances of business and economics and understand complex theories. Many are able to reach reasonable conclusions about value and prospects. But then psychology and crowd influences move in. Much of the time, assets are overpriced and appreciating further, or underpriced and still cheapening. Eventually these trends have a corrosive effect on investors' psyches, conviction and resolve. The stocks you rejected are making money for others, the ones you chose to buy are lower every day, and concepts you dismissed as unsafe or unwise, hot new issues, high-priced tech stocks without earnings, highly levered mortgage derivatives, are described daily as delivering for others. As an overpriced stock goes even higher or an underpriced stock continues to cheapen, it should get easier to do the right thing, sell the former and buy the latter. But it doesn't. The tendency toward self-doubt combines with news of other people's successes to form a powerful force that makes investors do the wrong thing, and it gains additional strength as these trends go on longer. It's one more influence that must be fought. The desire for more, the fear of missing out, the tendency to compare against others, the influence of the crowd and the dream of the sure thing, these factors are near universal. Thus they have a profound collective impact on most investors and most markets. This is especially true at the market extremes. The result is mistakes, frequent, widespread, recurring, expensive mistakes. Does all this strike you as just so much theorizing, something that couldn't possibly apply to you? I sincerely hope you're right. But just in case you doubt that rational people could succumb to the damaging forces of emotion, let me remind you of two little words: tech bubble. Earlier I mentioned that crazy time as evidence of what happens when investors disregard the need for a reasonable relationship between value and price. What is it that causes them to abandon common sense? Some of the same emotions we have been talking about here: greed, fear, envy, self-deceit, ego. Let's review the scenario and watch psychology at work. The 1990s were a very strong period for stocks. There were bad days and months, of course, and traumas such as a big jump in interest rates in 1994, but Standard & Poor's 500 stock index showed a gain every year from 1991 through 1999 inclusive, and its return averaged 20.8% per year. Those results were enough to put investors in an optimistic mood and render them receptive to bullish stories. Growth stocks performed a bit better than value stocks in the early part of the decade, perhaps as a rebound from value's outperformance in the 1980s. This, too, increased investors' willingness to highly value companies' growth potential. Investors became enthralled by technological innovation. Developments such as broadband, the internet and e-commerce seemed likely to change the world, and tech and telecom. Entrepreneurs were lionized. Tech stocks appreciated, attracting more buying, and this led to further appreciation, in a process that as usual took on the appearance of an unstoppable virtuous circle. Logical, seeming rationales play a part in most bull markets, and this one was no different. Tech stocks will outperform all other stocks because of the company's excellence. More tech names will be added to the equity indices, reflecting their growing importance in the economy. This will require index funds and the closet indexers, who covertly emulate indices to buy more of them, and active investors will buy to keep up as well. More people will create 401k retirement plans, and 401k investors will increase the representation of stocks in their portfolios and the allocation to tech stocks among their stocks. For these reasons, tech stocks, A, must keep appreciating and, B, must outpace other stocks. Thus they'll attract still more buying. The fact that all of these phenomena actually occurred for a while lent credence to this theory. Initial public offerings of technology. Stocks began to appreciate by tens and even hundreds of % on the day of issue and took on the appearance of sure winners. Gaining access to IPOs became a popular mania. From the perspective of psychology, what was happening with IPOs is particularly fascinating. It went something like this: the guy next to you in the office tells you about an IPO he's buying. You ask what the company does. He says he doesn't know, but his broker told him it's going to double on the day of issue. So you say that's ridiculous. A week later he tells you it didn't double, it tripled. And he still doesn't know what it does. After a few more of these, it gets hard to resist. You know it doesn't make sense, but you want protection against continuing to feel like an idiot. So, in a prime example of capitulation, you put in for a few hundred shares of the next IPO, and the bonfire grows still higher on the buying from new converts like you. Venture capital funds that had invested in successful startup companies attracted great attention and a great deal of capital. In the year Google went public, the fund that had seeded it appreciated 350% on the basis of that one success. Tech stock investors were lauded by the media for their brilliance. The ones least restrained by experience and skepticism, and thus making the most money, were often in their 30s, even their 20s. Never was it pointed out that they might be beneficiaries of an irrational market rather than incredible astuteness. Remember my earlier comment that all bubbles start with a modicum of truth. The seed of truth for the scenario just described lay in technology's very real potential. The fertilizer came from the attendant bullish rationales. And the supercharging came from the price appreciation that was taking place and looked unstoppable. Of course, the entire furor over technology, e-commerce and telecom stocks stems from the company's potential to change the world. I have absolutely no doubt that these movements are revolutionizing life as we know it, or that they will leave the world almost unrecognizable from what it was only a few years ago. The challenge lies in figuring Out who the winners will be, and what a piece of them is really worth today. To say technology, internet and telecommunications are too high and about to decline is comparable today to standing in front of a freight train. To say they have benefited from a boom of colossal proportions and should be examined skeptically is something I feel I owe you. Bubble.com, January 3, 2000. Soon after the January 2000 memo was written, the tech stocks began to collapse of their own weight, even in the absence of any single event that would cause them to do so. All of a sudden it became clear that stock prices had gone too far and should correct. When an investment fad goes bad, the Wall Street Journal usually runs a table showing the resulting losses, with representative stocks down 90% or more. When the tech bubble burst, however, the table showed losses exceeding 99%. The broad stock indices experienced their first 3-year decline since the Great Depression, and tech stocks, and stocks in general, no longer looked like anything special. When we look back over the intervening decade, we see that the vaunted technological developments did change the world, the winning companies are hugely valuable, and things like newspapers and CDs have been profoundly affected. But it's equally obvious that investors allowed their common sense to be overridden in the bubble. They ignored the fact that not all the companies could win, that there would be a lengthy shake-out period, that profitability wouldn't come easily from providing services gratis, and that shares in money-losing companies valued at high multiples of sales, since there were no earnings, carried great danger. Greed, excitement, illogicality, suspension of disbelief and ignoring value cost people a lot of money in the tech bubble. And, by the way, a lot of brilliant, disciplined value investors looked dumb in the months and years before the bubble burst, which of course it eventually did. To avoid losing money in bubbles, the key lies in refusing to join in when greed and human error cause positives to be wildly overrated and negatives to be ignored. Doing these things isn't easy, and thus few people are able to abstain. In just the same way, it's essential that investors avoid selling, and preferably should buy, when fear becomes excessive in a crash. That reminds me to point out that bubbles are capable of arising on their own and need not be preceded by crashes, whereas crashes are invariably preceded by bubbles. As hard as it was for most people to resist buying in the tech bubble, it was even harder to resist selling, and still more difficult to buy, in the depths of the credit crisis. At worst, failing to buy in a bull market means you may look like a laggard and experience opportunity costs. But in the crash of 2008, the downside of failing to sell appeared to be unlimited loss. Armageddon actually seemed possible. What, in the end, are investors to do about these psychological urges that push them toward doing foolish things? Learn to see them for what they are, that's the first step toward gaining the courage to resist. And be realistic. Investors who believe they're immune to the forces described in this chapter do so at their own peril. If they influence others enough to move whole markets, why shouldn't they affect you, too? If a bull case is so powerful that it can make adults overlook elevated valuations and deny the impossibility of the perpetual motion machine, why shouldn't it have the same influence on you? If a scare story of unlimited loss is strong enough to make others sell at giveaway prices, what would keep it from doing the same to you? Believe me, it's hard to resist buying at the top, and harder still to sell, when everyone else is buying, the pundits are positive, the rationale is widely accepted, prices are soaring and the biggest risk takers are reporting huge returns. It's also hard to resist selling, and very tough to buy, when the opposite is true at the bottom and holding or buying appears to entail the risk of total loss. Like so many other things described in this book, there's no simple solution, no formula that will tell you when the market has gone to an irrational extreme, no foolproof tool that will keep you on the right side of these decisions, no magic pill that will protect you against destructive emotions. As Charlie Munger says, it's not supposed to be easy. What weapons might you marshal on your side to increase your odds? Here are the ones that work for Oaktree: a strongly held sense of intrinsic value, insistence on acting as you should when price diverges from value, enough conversance with past cycles, gained at first from reading and talking to veteran investors, and later through experience, to know that market excesses are ultimately punished, not rewarded. A thorough understanding of the insidious effect of psychology on the investing process at market extremes, a promise to remember that when things seem too good to be true, they usually are, willingness to look wrong while the market goes from misvalued to more misvalued, as it invariably will, and like-minded friends and colleagues from whom to gain support, and for you to support. These things aren't sure to do the job, but they can give you a fighting chance. Chapter 11. The most important thing is contrarianism. To buy when others are despondently selling and to sell when others are euphorically buying takes the greatest courage, but provides the greatest profit. Sir John Templeton. There's only one way to describe most investors: trend followers. Superior investors are the exact opposite. Superior investing, as I hope I've convinced you by now, requires second-level thinking, a way of thinking that's different from that of others, more complex and more insightful. By definition, most of the crowd can't share it. Thus, the judgments of the crowd can't hold the key to success. Rather, the trend, the consensus view, is something to game against, and the consensus portfolio is one to diverge from. As the pendulum swings or the market goes through its cycles, the key to ultimate success lies in doing the opposite. This is the core of Warren Buffett's oft-quoted advice: the less prudence with which others conduct their affairs, the greater the prudence with which we should conduct our own affairs. He is urging us to do the opposite of what others do, to be contrarians. Doing the same thing others do exposes you to fluctuations that in part are exaggerated by their actions and your own. It's certainly undesirable to be part of the herd when it stampedes off the cliff, but it takes rare skill, insight, and discipline to avoid it. The Realist's Creed, May 31, 2002. The logic of crowd error is clear and almost mathematical. Markets swing dramatically, from bullish to bearish and from overpriced to underpriced. Their movements are driven by the actions of the crowd, the herd, or most people. Bull markets occur because more people want to buy than sell, or the buyers are more highly motivated than the sellers. The market rises as people switch from being sellers to being buyers, and as buyers become even more motivated and the sellers less so. If buyers didn't predominate, the market wouldn't be rising. Market extremes represent inflection points. These occur when bullishness or bearishness reaches a maximum. Figuratively speaking, a top occurs when the last person who will become a buyer does so. Since every buyer has joined the bullish herd by the time the top is reached, bullishness can go no further and the market is as high as it can go. Buying or holding is dangerous. Since there's no one left to turn bullish, the market stops going up. And if on the next day one person switches from buyer to seller, it will start to go down. So at the extremes, which are created by what most people believe, most people are wrong. Therefore, the key to investment success has to lie in doing the opposite, in diverging from the crowd. Those who recognize the errors that others make can profit enormously through contrarianism. From time to time we see rabid buyers or terrified sellers, urgency to get in or to get out, overheated markets or ice-cold markets, and prices unsustainably high or ridiculously low. Certainly the markets, and investor attitudes and behavior, spend only a small portion of the time at the happy medium. What does this say about how we should act? Joining the herd and participating in the extremes of these cycles obviously can be dangerous to your financial health. The market's extreme highs are created when avid buyers are in control, pushing prices to levels that may never be seen again. The lows are created when panicky sellers predominate, willing to part with assets at prices that often turn out to have been grossly inadequate. Buy low, sell high is the time-honored dictum, but investors who are swept up in market cycles too often do just the opposite. The proper response lies in contrarian behavior: buy when they hate M and sell when they love M. Once in a lifetime, market extremes seem to occur once every decade or so, not often enough for an investor to build a career around capitalizing on them. But attempting to do so should be an important component of any investor's approach. Just don't think it'll be easy. You need the ability to detect instances in which prices have diverged significantly from intrinsic value. You have to have a strong enough stomach to defy conventional wisdom, one of the greatest oxymorons, and resist the myth that the market's always efficient and thus right. You need experience on which to base this resolute behavior. And you must have the support of understanding, patient constituencies. Without enough time to ride out the extremes while waiting for reason to prevail, you'll become that most typical of market victims, the 6-foot-tall man who drowned crossing the stream that was 5 feet deep on average. But if you're alert to the pendulum-like swing of the markets, it's possible to recognize the opportunities that occasionally are there for the plucking. The Happy Medium, July 21, 2004. Accepting the broad concept of contrarianism is one thing. Putting it into practice is another. On one hand, we never know how far the pendulum will swing, when it will reverse, and how far it will then go in the opposite direction. On the other hand, we can be sure that, once it reaches an extreme position, the market eventually will swing back toward the midpoint, or beyond. Investors who believe that the pendulum would move in one direction forever, or, having reached an extreme, would stay there, are inevitably disappointed. On the third hand, however, because of the variability of the many factors that influence markets, no tool, not even contrarianism, can be relied on completely. Contrarianism isn't an approach that will make you money all of the time. Much of the time there aren't great market excesses to bet against. Even when an excess does develop, it's important to remember that overpriced is incredibly different from going down tomorrow. Markets can be over or underpriced and stay that way, or become more so for years. It can be extremely painful when the trend is going against you. It can appear at times that everyone has reached the conclusion that the herd is wrong. What I mean is that contrarianism itself can appear to have become too popular, and thus contrarianism can be mistaken for herd behavior. Finally, it's not enough to bet against the crowd. Given the difficulties associated with contrarianism just mentioned, the potentially profitable recognition of divergences from consensus thinking must be based on reason and analysis. You must do things not just because they're the opposite of what the crowd is doing, but because you know why the crowd is wrong. Only then will you be able to hold firmly to your views and perhaps buy more as your positions take on the appearance of mistakes and as losses accrue rather than gains. David Swensen heads the Yale University Endowment. Yale's investment performance has been outstanding, and Swensen has had a greater impact on endowment investing than anyone else over the last 2 decades. His thinking, which was highly unusual when Yale began to implement it in the 1980s, came to represent endowment canon. He has a beautiful way of describing the difficulties associated with contrarianism. Investment success requires sticking with positions made uncomfortable by their variance with popular opinion. Casual commitments invite casual reversal, exposing portfolio managers to the damaging whipsaw of buying high and selling low. Only with the confidence created by a strong decision-making process can investors sell speculative excess and buy despair-driven value. Active management strategies demand uninstitutional behavior from institutions, creating a paradox that few can unravel. Establishing and maintaining an unconventional investment profile requires acceptance of uncomfortably idiosyncratic portfolios, which frequently appear downright imprudent in the eyes of conventional wisdom. Pioneering portfolio management, 2000. The ultimately most profitable investment actions are by definition contrarian. You're buying when everyone else is selling, and the price is thus low, or you're selling when everyone else is buying, and the price is high. These actions are lonely and, as Swenson says, uncomfortable. How can we know it's the opposite, the consensus action, that's the comfortable one? Because most people are doing it. The thing I find most interesting about investing is how paradoxical it is, how often the things that seem most obvious, on which everyone agrees, turn out not to be true. I'm not saying accepted investment wisdom is sometimes valid and sometimes not. The reality is simpler and much more systematic. Most people don't understand the process through which something comes to have outstanding money-making potential. What's clear to the broad consensus of investors is almost always wrong. The very coalescence of popular opinion behind an investment tends to eliminate its profit potential. Take, for example, the investment that everyone believes to be a great idea. In my view, by definition, it simply cannot be so. If everyone likes it, it's probably because it has been doing well. Most people seem to think outstanding performance to date presages outstanding future performance. Actually, it's more likely that outstanding performance to date has borrowed from the future, and thus presages subpar performance from here on out. If everyone likes it, it's likely the price has risen to reflect a level of adulation from which relatively little further appreciation is likely. Sure, it's possible for something to move from overvalued to more overvalued, but I wouldn't want to count on it happening. If everyone likes it, it's likely the area has been mined too thoroughly, and has seen too much capital flow in, for many bargains to remain. If everyone likes it, there's significant risk that prices will fall if the crowd changes its collective mind and moves for the exit. Superior investors know, and buy, when the price of something is lower than it should be. And the price of an investment can be lower than it should be only when most people don't see its merit. Yogi Berra is famous for having said, "Nobody goes to that restaurant anymore, it's too crowded." It's just as nonsensical to say, everyone realizes that investment's a bargain. If everyone realizes it, they'll buy in. Which case the price will no longer be low. Large amounts of money aren't made by buying what everybody likes. They're made by buying what everybody underestimates. In short, there are two primary elements in superior investing: seeing some quality that others don't see or appreciate, and that isn't reflected in the price, and having it turn out to be true, or at least accepted by the market. It should be clear from the first element that the process has to begin with investors who are unusually perceptive, unconventional, iconoclastic, or early. That's why successful investors are said to spend a lot of their time being lonely. Everyone knows, April 26, 2007, the global credit crisis of 2007 to 2008 represents the greatest crash I have ever seen. The lessons to be learned from this experience are many, which is one reason I discuss aspects of it in more than one chapter. For me, one such lesson consisted of reaching a new understanding of the skepticism required for contrarian thinking. I'm not usually given to epiphanies, but I had one on the subject of skepticism. Every time a bubble bursts, a bull market collapses, or a silver bullet fails to work, we hear people bemoan their error. The skeptic, highly aware of that, tries to identify delusions ahead of time and avoid falling into line with the crowd in accepting them. So, usually, investment skepticism is associated with rejecting investment fads, bull market manias, and Ponzi schemes. My epiphany came in mid-October 2008, near the low point of the global credit meltdown. By then we were seeing and hearing things that we never imagined possible: the demise or bailout of Lehman Brothers, Bear Stearns, Freddie Mac, Fannie Mae and AIG, concern about the viability of Goldman Sachs and Morgan Stanley, and huge declines in their stocks, rising prices for credit default swap protection on U.S. Treasury securities rates on short-term T-bills close to zero because of an extreme flight to safety. Awareness for the first time, I think, that the U.S. government's financial resources are finite and that there are limits on its ability to run the printing press and solve problems it Was readily apparent immediately after the bankruptcy of Lehman Brothers that a spiral was underway, and no one could see how or when it might end. That was really the problem. No scenario was too negative to be credible, and any scenario incorporating an element of optimism was dismissed as Pollyanna-ish. There was an element of truth in this, of course. Nothing was impossible. But in dealing with the future, we must think about two things: A, what might happen, and B, the probability that it will happen. During the crisis, lots of bad things seemed possible, but that didn't mean they were going to happen. In times of crisis, people fail to make that distinction. For 40 years I've seen the manic, depressive pendulum of investor psychology swing crazily, between fear and greed. We all know the refrain, but also between optimism and pessimism, and between credulity and skepticism. In general, following the beliefs of the herd, and swinging with the pendulum, will give you average performance in the long run and can get you killed at the extremes. If you believe the story everyone else believes, you'll do what they do. Usually you'll buy at high prices and sell at lows. You'll fall for tales of the silver bullet, capable of delivering high returns without risk. You'll buy what's been doing well and sell what's been doing poorly. And you'll suffer losses in crashes and miss out when things recover from bottoms. In other words, you'll be a conformist, not a maverick, a follower, not a contrarian. Skepticism is what it takes to look behind a balance sheet, the latest miracle of financial engineering or the can't-miss story. Only a skeptic can separate the things that sound good and are from the things that sound good and aren't. The best investors I know exemplify this trait. It's an absolute necessity. Lots of bad things happened to kick off the credit crisis that had been considered unlikely, if not impossible, and they happened at the same time, to investors who'd taken on significant leverage. So the easy explanation is that the people who were hurt in the credit crisis hadn't been skeptical, or pessimistic, enough. But that triggered an epiphany: skepticism and pessimism aren't synonymous. Skepticism calls for pessimism when optimism is excessive. But it also calls for optimism when pessimism is excessive. As the credit crisis reached a peak last week, I found very few who were optimistic. Most were pessimistic to some degree. No one applied skepticism, or said that horror story's unlikely to be true. The one thing they weren't doing last week was making aggressive bids for securities. So prices fell and fell. The old expression is gap down, several points at a time. The key, as usual, was to become skeptical of what everyone was saying and doing. The negative story may have looked compelling, but it's the positive story, which few believed, that held, and still holds, the greater potential for profit. The Limits to Negativism, October 15, 2008. The error is clear. The herd applies optimism at the top and pessimism at the bottom. Thus, to benefit, we must be skeptical of the optimism that thrives at the top, and skeptical of the pessimism that prevails at the bottom. Touchstones, November 10, 2009. Skepticism is usually thought to consist of saying, "No, that's too good to be true," at the right times. But I realized in 2008, and in retrospect it seems so obvious, that sometimes skepticism requires us to say, "No, that's too bad to be true." Most purchases of distressed debt made in the fourth quarter of 2008 yielded returns of 50 to 100% or more over the next 18 months. Buying was extremely difficult under those trying circumstances, but it was made easier when we realized that almost no one was saying, "No, things can't be that bad." At that moment, being optimistic and buying was the ultimate act of contrarianism. Certain common threads run through the best investments I've witnessed. They're usually contrarian, challenging and uncomfortable, although the experienced contrarian takes comfort from his or her position outside the herd. Whenever the debt market collapses, for example, most people say, "We're not going to try to catch a falling knife, it's too dangerous." They usually add, "We're going to wait until the dust settles and the uncertainty is resolved." What they mean, of course, is that they're frightened and unsure of what to do. The one thing I'm sure of is that by the time the knife has stopped falling, the dust has settled and the uncertainty has been resolved, there'll be no great bargains left. When buying something has become comfortable again, its price will no longer be so low that it's a great bargain. Thus, a hugely profitable investment that doesn't begin with discomfort is usually an oxymoron. It's our job as contrarians to catch falling knives, hopefully with care and skill. That's why the concept of intrinsic value is so important. If we hold a view of value that enables us to buy when everyone else is selling, and if our view turns out to be right, that's the route to the greatest rewards earned with the least risk. Chapter 12. The most important thing is finding bargains. The best opportunities are usually found among things most others won't do. The process of intelligently building a portfolio consists of buying the best investments, making room for them by selling lesser ones, and staying clear of the worst. The raw materials for the process consist of a list of potential investments, b. estimates of their intrinsic value, c. a sense for how their prices compare with their intrinsic value, and d. an understanding of the risks involved in each, and of the effect their inclusion would have on the portfolio being assembled. The first step is usually to make sure that the things being considered satisfy some absolute standards. Even sophisticated investors may not say, "I'll buy anything if it's cheap enough." More often they create a list of investment candidates meeting their minimum criteria, and from those they choose the best bargains. That's what this chapter is all about. For example, an investor might start by narrowing the list of possibilities to those whose riskiness falls within acceptable limits, since there can be risks with which certain investors aren't comfortable. Examples might include the risk of obsolescence in a fast-moving segment of the technology world, and the risk that a hot consumer product will lose its popularity. These might be subjects that some investors consider beyond their expertise. Or investors might find some companies unacceptable in the absolute because their industries are too unpredictable or their financial statements aren't sufficiently transparent. It's not unreasonable to want to emphasize assets that fall within a certain portion of the risk spectrum. Securities that the market deems ultra-safe may offer uninteresting returns, while securities at the other extreme may exceed investors' risk tolerance. In other words, there can reasonably be some places investors won't go, regardless of price. Not only can there be risks investors don't want to take, but also there can be risks their clients don't want them to take. Especially in the institutional world, managers are rarely told, "Here's my money, do what you want with it." The money manager's job isn't just to make investments with profit potential, but also to give clients what they want, since most institutional investors are hired to carry out specific assignments in terms of asset class and investment style. If the client came for one kind of investment, there's little to be gained in going into others, regardless of their attractiveness. For example, if a manager solicits accounts on the basis of expertise in high-quality, large capitalization value stocks, there's risk to the business in investing in a bunch of high-tech startups. Thus, the starting point for portfolio construction is unlikely to be an unbounded universe. Some things are realistic candidates for inclusion, and others aren't. Having defined the feasible set, the next step is to select investments from it. That's done by identifying those that offer the best ratio of potential return to risk, or the most value for the money. That's what Sid Cottle, editor of the later editions of Graham and Dodd's Security Analysis, was talking about when he told me that in his view, investment is the discipline of relative selection. That expression has stayed with me for 35 years. Sid's simple phrase embodies two important messages. First, the process of investing has to be rigorous and disciplined. Second, it is by necessity comparative. Whether prices are depressed or elevated, and whether prospective returns are therefore high or low, we have to find the best investments out there. Since we can't change the market, if we want to participate, our only option is to select the best from the possibilities that exist. These are relative decisions. What is it that makes something the superior investment we look for? As I mentioned in Chapter 4, it's largely a matter of price. Our goal isn't to find good assets, but good buys. Thus, it's not what you buy, it's what you pay for it. A high-quality asset can constitute a good or bad buy, and a low-quality asset can constitute a good or bad buy. The tendency to mistake objective merit for investment opportunity, and the failure to distinguish between good assets and good buys, get most investors into trouble. Because the search is for good buys, my main goal in this chapter is to explain what makes a buy a good one. In general, that means price is low relative to value, and potential return is high relative to risk. How do bargains get that way? In Chapter 10, I used the tech stock mania as an example of the reliable process through which a good fundamental idea can be turned into an overpriced bubble. It usually starts with an objectively attractive asset. As people raise their opinion of it, they increasingly want to own it. That makes capital flow to it, and the price rises. People take the rising price as a sign of the investment's merit, so they buy still more. Others hear about it for the first time and join in, and the upward trend takes on the appearance of an unstoppable virtuous cycle. It's mostly a popularity contest in which the asset in question is the winner. If they go on long enough and gain enough force, investment styles turn into bubbles. And bubbles give thoughtful investors lots of things to sell and sell short. The process through which bargains are created is largely the opposite. Thus, to be able to find them, it's essential that we understand what causes an asset to be out of favor. This isn't necessarily the result of an analytical process. In fact, much of the process is anti-analytical. Meaning it's important to think about the psychological forces behind it and the changes in popularity that drive it. So what is it that makes price low relative to value, and return high relative to risk? In other words, what makes something sell cheaper than it should? Unlike assets that become the subject of manias, potential bargains usually display some objective defect. An asset class may have weaknesses, a company may be a laggard in its industry, a balance sheet may be over-levered, or a security may afford its holders inadequate structural protection. Since the efficient market process of setting fair prices requires the involvement of people who are analytical and objective, bargains usually are based on irrationality or incomplete understanding. Thus, bargains are often created when investors either fail to consider an asset fairly, or fail to look beneath the surface to understand it thoroughly, or fail to overcome some non-value-based tradition, bias, or stricture. Unlike market darlings, the orphan asset is ignored or scorned. To the extent it's mentioned at all by the media and at cocktail parties, it's in unflattering terms. Usually its price has been falling, making the first-level thinker ask, who would want to own that? It bears repeating that most investors extrapolate past performance, expecting the continuation of trends rather than the far more dependable regression to the mean. First-level thinkers tend to view past price weakness as worrisome, not as a sign that the asset has gotten cheaper. As a result, a bargain asset tends to be one that's highly unpopular. Capital stays away from it or flees, and no one can think of a reason to own it. Here's an example of how bargains can be created when an entire asset class goes out of style. The story of bonds in the last 60 years is the mirror opposite of the rise in popularity enjoyed by stocks. First, bonds wilted as stocks monopolized the spotlight in the 50s and 60s, and at the end of 1969, first National City Bank's weekly summary of bond data died with the heading, "The Last Issue, Boxed in Black." Bonds were decimated in the high interest rate environment of the 70s, and even though interest rates declined steadily during the 80s and 90s, bonds didn't have a prayer of standing up to equity's dramatic gains. By the latter half of the 90s, any investment in bonds rather than stocks felt like an anchor restraining performance. I chaired the investment committee of a charity and watched as a sister or GANIZA tie-in in another city, which had suffered for years, with an 80:20 bond/stock mix, shifted its allocation to 0:100. I imagined a typical institutional investor saying the following: "We have a small allocation to fixed income. I can't tell you why. It's a historical accident. My predecessor created it, but his reasons are lost in the past. Now our bond holdings are under review for reduction." Even though interest in buying more stocks remained low in the current decade, little money flowed to high-grade bonds. The continued decline in bonds' popularity was caused, among other things, by the decision on the part of the Greenspan Fed to keep interest rates low to stimulate the economy and combat exogenous shocks, like the Y2K scare. With treasuries and high-grade bonds yielding 3–4%, they didn't do much for institutional investors trying for 8%. Hemlines, September 10, 2010. After the process described above had gone on long enough, and holdings of them had been reduced enough, bonds were positioned to become superior performers. All it took was a change in the environment that would increase the desirability of safety relative to upside potential. And as usually happens after an asset has appreciated for a while, investors suddenly recognized the attractions of bonds and realized they didn't own enough. This is a pattern that regularly produces profits for those who figure it out early. Fairly priced assets are never our objective, since it's reasonable to conclude they'll deliver just fair returns for the risk involved. And, of course, overpriced assets don't do us any good. Our goal is to find underpriced assets. Where should we look for them? A good place to start is among things that are little known and not fully understood, fundamentally questionable on the surface. Controversial, unseemly or scary, deemed inappropriate for respectable portfolios, unappreciated, unpopular and unloved, trailing a record of poor returns, and recently the subject of disinvestment, not accumulation. To boil it all down to just one sentence, I'd say the necessary condition for the existence of bargains is that perception has to be considerably worse than reality. That means the best opportunities are usually found among things most others won't do. After all, if everyone feels good about something and is glad to join in, it won't be bargain priced. When I shifted from equity research to portfolio management at Citibank in 1978, I was fortunate to be asked to work in asset classes that met some or all of these criteria. My first assignment was in convertible securities. These were even more of a small and underappreciated market backwater than they are now, since they gave investors the advantages of both bonds and stocks. They were issued only as a last resort by weak companies lacking alternatives, such as conglomerates, railroads and airlines. Mainstream investors felt they introduced unnecessary complexity. If you want the characteristics of bonds and stocks, they might say, why not just buy some bonds and some stocks? And if you like the company, why not buy the stock and garner its entire return, rather than investing in a defensive hybrid vehicle? Well, whenever everyone feels there's no merit in something, it's reasonable to suspect it's unloved, unpursued and thus possibly underpriced. That's why a 1984 Businessweek article about me carried the line, "Real men don't buy converts, so chickens like me can buy cheap." Later in 1978, I was asked to start a fund for high-yield bonds. These low-rated securities, burdened with the unpleasant sobriquet junk bonds, fell short of most investing institutions' minimum requirement of investment grade or better or single A or better. Junk bonds might default. So how could they possibly be appropriate holdings for pension funds or endowments? And If a fund bought a bond from a speculative, grade company and it went under, how could the trustees escape embarrassment and blame for having done something that they knew in advance was risky? A great clue to these securities' potential could be found in one rating agency's description of B-rated bonds as generally lacking the characteristics of a desirable investment. By now you should be quick to ask how anyone could issue a blanket dismissal of a potential class of investments without any reference to price. The subsequent history of these bonds shows that, A, if nobody owns something, demand for it, and thus the price, can only go up, and, B, by going from taboo to even just tolerated, it can perform quite well. Finally, in 1987, my partners Bruce Karsh and Sheldon Stone came to me with the bright idea of forming a fund to invest in distressed debt. What could possibly be more unseemly and less respectable than investing in the bonds of companies that are bankrupt or deemed overwhelmingly likely to become so? Who would invest in companies that already had demonstrated their lack of financial viability and the weakness of their management? How could anyone invest responsibly in companies in free fall? Of course, given the way investors behave, whatever asset is considered the worst at a given point in time has a good likelihood of being the cheapest. Investment bargains needn't have anything to do with high quality. In fact, things tend to be cheaper if low quality has scared people away. Each of these asset classes satisfied most or all of the criteria listed earlier in this chapter. They were little known, not understood, and not respected. No one had a good word to say about any of them. Each exemplified the uncomfortably idiosyncratic and imprudent appearing investments that David Swenson talked about in Chapter 11. And thus each turned into a great place to be for the next 20 or 30 years. I hope these large-scale examples give you a good idea for where bargains may be found. Since bargains provide value at unreasonably low prices, and thus unusual ratios of return to risk, they represent the holy grail for investors. Such deals shouldn't exist in an efficient market for the reasons specified in Chapter 2. However, everything in my experience tells me that while bargains aren't the rule, the forces that are supposed to eliminate them often fail to do so. We're active investors because we believe we can beat the market by identifying superior opportunities. On the other hand, many of the special deals we're offered are too good to be true, and avoiding them is essential for investment success. Thus, as with so many things, the optimism that drives one to be an active investor and the skepticism that emerges from the presumption of market efficiency must be balanced. It's obvious that investors can be forced into mistakes by psychological weakness, analytical error, or refusal to tread on uncertain ground. Those mistakes create bargains for second-level thinkers capable of seeing the errors of others. Chapter 13. The most important thing is patient opportunism. The market's not a very accommodating machine. It won't provide high returns just because you need them. Peter Bernstein. The boom-bust cycle associated with the global financial crisis gave us the chance to sell at highly elevated levels in the period 2005 through early 2007, and then to buy at panic prices in late 2007 and 2008. This was in many ways the chance of a lifetime. Cycle-fighting contrarians had a golden opportunity to distinguish themselves. But one of the things I want to do in this chapter is to point out that there aren't always great things to do, and sometimes we maximize our contribution by being discerning and relatively inactive. Patient opportunism, waiting for bargains, is often your best strategy. So here's a tip: you'll do better if you wait for investments to come to you rather than go chasing after them. You tend to get better buys if you select from the list of things sellers are motivated to sell rather than start with a fixed notion as to what you want to own. An opportunist buys things because they're offered at bargain prices. There's nothing special about buying when prices aren't low. At Oaktree, one of our mottos is, we don't look for our investments, they find us. We try to sit on our hands. We don't go out with a buy list, rather, we wait for the phone to ring. If we call the owner and say, "You own X and we want to buy it," the price will go up. But if the owner calls us and says, "We're stuck with X and we're looking for an exit," the price will go down. Thus, rather than initiating transactions, we prefer to react opportunistically. At any particular point in time, the investment environment is a given, and we have no alternative other than to accept it and invest within it. There isn't always a pendulum or cycle extreme to bet against. Sometimes greed and fear, optimism and pessimism, and credulousness and skepticism are balanced, and thus clear mistakes aren't being made. Rather than obviously overpriced or underpriced, most things may seem roughly fairly priced. In that case, there may not be great bargains to buy or compelling sales to make. It's essential for investment success that we recognize the condition of the market and decide on our actions accordingly. The other possibilities are A. Acting without recognizing the market status, B. Acting with indifference to its status, and C. Believing we can somehow change its status. These are most unwise. It makes perfect sense that we must invest appropriately for the circumstances with which we're presented. In fact, nothing else makes sense at all. I come to this from a philosophic foundation. In the mid-60s, Wharton students had to have a non-business minor, and I satisfied the requirement by taking 5 courses in Japanese studies. These surprised me by becoming the highlight of my college career, and later they contributed to my investment philosophy in a major way. Among the values prized in early Japanese culture was mujo. Mujo was defined classically for me as recognition of the turning of the wheel of the law, implying acceptance of the inevitability of change, of rise and fall. In other words, mujo means cycles will rise and fall, things will come and go, and our environment will change in ways beyond our control. Thus we must recognize, accept, cope and respond. Isn't that the essence of investing? What's past is past and can't be undone. It has led to the circumstances we now face. All we can do is recognize our circumstances for what they are and make the best decisions we can, given the givens. It is what it is. March 27, 2006. Warren Buffett's philosophy is a little less spiritually based than mine. Instead of mujo, his reference is to baseball. In Berkshire Hathaway's 1997 annual report, Buffett talked about Ted Williams, the splendid splinter, one of the greatest hitters in history. A factor that contributed to his success was his intensive study of his own game. By breaking down the strike zone into 77 baseball-sized cells and charting his results at the plate, he learned that